New evidence from the perma bears, the politicalization of brands, PGIM Fixed Income's Michael Collins, all today on The Bottom Line from the NASDAQ market site in Times Square.
Market is still at record highs, but we have had the equivalent of a couple of fund managers charging into the street, waving warning flags. Yes, they have been sounding the warning for a long time, but one of them, John Hussman, points to valuations being near record highs, also says he has seen signs of a, quote, Hindenburg and a Titanic in terms of market internals, advanced decline line, and other technical factors. So he is warning about it. And Albert Edwards, another famed bear, has come out with a new scary thing, the vacation indicator. Sarah, what is he talking about?
He says that we should be worried that about 63% of Americans intend to take a vacation in the next 6 months, which is interesting. It's at an all-time high. Why is this bad? He says that it's showing some future wage inflation that hasn't been priced into the market yet. People thinking like, oh, this is coming, and so they start to plan vacations.
So in other words, finally, after 10 years of fear-mongering about inflation, we're going to get a little inflation, the Fed will freak out and slam on the brakes, and the market will tank.
That's what he says. Yes, okay. That's what he says.
So, Sarah, is this just the last desperate play by the perma bears before the market doubles from here? Or are they finally onto something?
It's possible. I mean, it's hard to know the timing of when they're going to be right. They will be right eventually, but when they'll be right is a good question.
Because a lot of people think, actually, we just started a new secular market. There seem to be no risk. A lot of the folks that we interview regularly say, hey, valuations are fine. Interest rates are low, earnings growth. So it's very hard to know. I will say that a lot of what John Hussman in particular talks about is very reminiscent to me of the 1990s, where in the second half of the 1990s, every year you would have these famous value investors who had lagged the market for years because they'd been too cautious, be shamed, fired, carried out on stretchers. We're not really seeing that. Hussman has been shamed, which is often a sign that he's going to be right and everyone is going to look very stupid. But he's been wrong for a long time. Same with Albert Edwards, perma bear label. Like, I am concerned about what they're talking about, but boy, is it hard to know when you should really worry about it.
Yeah, and wage inflation is something we've seen a disconnect between unemployment and wage inflation, and the Phillips curve is completely broken down. And a lot of people talk about structural unemployment, and like wage inflation may never come from this correction.
And it is possible that if we do get a little bit of wage inflation, that suddenly may flow through to purchasing power. The overall economy could accelerate. Presumably the market would like that. So again, here we are. But be warned, don't freak out, but nobody should be surprised based on valuations if we suddenly have a 50% drop in the market over a year or two, because that's where valuations are. They're really twice normal levels. This week could be known as Smash Your Keurig Week, because there was a huge protest when the advertiser Keurig coffee maker pulled its advertising from Hannity, because Hannity on Fox News was being very vocal defending the Senate candidate in Alabama, saying, hey, that thing with that 14-year-old, that was consensual, there was justifiable outrage. But now there's a backlash among Hannity viewers saying, how dare you? You've taken a side. And Keurig has come out and said, whoa, 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 we didn't mean to take a side. We just thought this was just blatantly offensive. We didn't want to be associated with it. This continues a string of companies that have sort of waded into this political division in the country. Starbucks first, on the liberal side, some boycotts on the conservative side. Papa John's CEO has been very vocal, blaming the NFL for not controlling the protest for his lousy pizza sales. And now Keurig, meanwhile, we should add, even Sean Hannity is now backed off, so I'm not sure those who smashed their Keurigs are really pleased that they've done that. But Sarah, should companies be taking a political side? I mean, this is something people really care about, feel it deeply. Should companies do this?
Well, I mean, I don't think that Keurig was trying to take a side. I think that they just pulled their advertising like 23andMe and other companies also did. But they have a product that you can smash. But consumers are allowed to vote with their wallets. It's well within their right. And Keurig is a private company, and it's well within their right to express their viewpoints and what they want to be associated with. So it's really hard to say whether or not it works from a business standpoint. It seems like Papa John's may be trying to appeal to a certain demographic. I'm not sure. They might just be trying to explain away their slump in sales, but that seemed to have backfired a little bit for them too. So whether or not it makes sense from a business standpoint, I'm not sure.
And Papa John's, interestingly, I think that is a case where the founder feels very passionate. He has ranted about the evils of government regulation and was pro-Trump. During the election, talked about that, so he has been out there. He's very much associated with the brand, so it's an easy step, I think, for them to take this position. But interestingly, 2 weeks after a conference call in which he slammed the NFL again, he has come out, and Papa John's is now saying, whoa, 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 you know, we actually support the players' right to protest. We look forward to working with them. And by the way, they had a little emoticon flipping off neo-Nazis. So they are clearly trying to say, hey, wait a minute, you know, we may be supportive of some of these things, but not some other things that are happening in the country, which I think lots of Americans would say, well, thank goodness you're not supporting neo-Nazis. So it seems like some companies, they want to draw the line somewhere, but it's where it is. And I have to say, from a business perspective, long term, businesses have run the other way from any sort of political stance. And founders and CEOs, you're supposed to keep that stuff out. I mean, it's the same thing it used to be in polite conversations. Like, don't bring up politics at the dinner table. It's like bringing up Yankees and Red Sox. People are immediately going to go insane on both sides. So I think it's bad. And yet, some of the things that have come up have been so core to what America used to be about. You can't blame people for saying, look, we draw the line here.
It used to be individual issues where people felt like this was on the right side or the wrong side, and now it feels like this is on the Republican or the Democrat side. And it didn't always used to be that way, I think. So now whenever somebody takes a stance on any social issue, they're picking a side, a political side.
Which I think is actually very important and problematic. And if the country is going to move past this, we actually have to start remembering what unites us instead of what separates us. And I think the companies that are going to be most successful are the ones that do that. But I will just add as a footnote, I talked to a friend of mine in the Valley recently. He said he's starting to see business plans that are aimed at one team or the other. Shoes for Republicans,
wow,
for example. And you can see that at least short term in this climate, that actually might allow you to build a big business. Can SportsCenter on Snapchat save Disney and ESPN? That is the question. If you've been following Disney stock for a while, you'll note that the stock's march upwards was interrupted about a year ago when concerns began to develop about ESPN losing subscribers. Sarah, certainly we've seen that. Subscribers have dropped. ESPN and Disney do have a lot of diversification. Sports is a bright spot for television, but it is a concern. But now they are diversifying into other platforms.
Yeah.
And we have a clip.
Yeah, this is their new Snapchat show for SportsCenter.
Tom Brady, good at football. That we already knew. But Dwayne Allen, not so much.
It's pretty good. It is very millennial focused. They're talking directly to the camera. The hosts are a lot younger. It's completely different from the SportsCenter as we know it.
And is it going to save ESPN and Disney?
I mean, I don't think so. I think it's a good idea, but it doesn't seem like it's going to recover like what they had. People used to go to SportsCenter to watch clips of games, and now it doesn't seem that there's a big need for that.
Right, and also cable is so absurdly lucrative for ESPN that it's hard to see, certainly on a subscriber basis, that it begins to replace that. But it is diversified, and again, this concern that ESPN is going to suddenly implode seems to be crazy. Sports are the bright spot in television. ESPN has a great position there. Just a question of, can they manage the decline in a fashion that will give Disney itself time to diversify? We shall see. One of the biggest winners in the stock market this year has been Alibaba. And it seems like the higher the stock goes, the more the company's CEO, Jack Ma, unleashes his inner entertainer. First it was dancing, then it was singing, and now, Sarah, you tell me that he is releasing a kung fu movie.
Yeah, all in the last month. Over the weekend, he released a 20-minute short film where he takes on 8 attackers with his Tai Chi skills, and which he's been studying for 30 years. One of them is Jet Li, who he defeats. He defeats all of them. 100 million people have watched it, and according to Alibaba, nobody was paid for their performances. And even at the end, Manny Pacquiao and Jason Statham are there, like, being like, Jack Ma, bring it on. So it seems like there might actually be a sequel.
And I have to say, maybe this is what you do when you're the CEO of a company worth $500 billion. Nothing else to do. On the other hand, Jack Ma is pulling this off. There was a lot of controversy around the original dancing and then the singing, but boy, the stars are aligning for Mr. Ma.
He's so good in this, I think. I mean, I really enjoy it. And I feel like if Business Insider becomes one of the most powerful companies in the world, then I feel like we should figure out like what our dream casting roles would be.
We'll get to work on that. Congratulations to Jack and Alibaba.
I'm here with Michael Collins, Managing Director and Senior Portfolio Manager at PGIM Fixed Income. Thank you so much for joining me.
Thank you.
So to start with Powell, what role does the Fed play in regulatory policy, and what impact will Powell have versus a Yellen?
Well, the Fed obviously has a big role in terms of regulating the banks, right? And that's one of the big regulatory changes we saw after the great financial crisis. And in my mind, it was actually a lot of those regulations were favorable. And even the bankers, the Jamie Dimons of the world, would agree that they like being better capitalized. They like being safer institutions. And now we're at a point where maybe we're at a turning point in the pendulum where regulations are going to be rolled back. And Powell, I think one of the reasons Trump preferred him over Yellen, he's clearly going to be a little more of a dove on the regulatory policy front. And there are still a handful, 4 or 5 other central bank FOMC members who are going to be appointed, and Trump has an opportunity to pick a deregulatory slate of governors. And
will there be a big difference on a monetary policy side?
I think the monetary policy, as strange as this might sound, is a little bit of, it's going to be on a transparent path, right? And the Fed has outlined what they want to do with regard to the bond tapering. Right, that has been laid out very clearly. With regard to Fed rate hikes, they still have those 3 dots next year and a hike in December. So that's 4 hikes between now and the end of next year. The big question is, are they going to do all 4, or are they going to do 1 or 2 or 3? The over-under is probably 2.
And that's what the market's pricing in, right? Is 2?
The markets are pricing in just over 2 between now and the end of next year. Our best guess is that they hike in December, even though that's not even set in stone yet. I mean, Evans came out, he said, you know what, we should really let inflation run a little bit, get consumers confident that inflation's going to go up before we start hiking too much, which is really showing that the Fed's maybe getting some cold feet on the Fed rate hikes. But my best guess is there's going to be 2 hikes next year. If they hike 3 times, it means the economy's hot and the markets are hot. If they hike once, it probably means we've hit a speed bump on one of those measures.
And if they hike 3 times, what does that mean for markets? The market is hot, but how will the market react?
It means the market's hot. It means things are going well. It's good for your job. It's good for your income. It's good for housing. It's good for real estate. It's good for the markets. The problem is if they hike 3 times next year and continue to hike in 19, remember they have 3 hikes slated for next year and another 3 almost in 2019. We think that's way too much. We think 7 hikes between now and the end of 19 will really take away the punch bowl. And that'll cause the curve to flatten and probably the markets to sell off and maybe even cause a recession.
And when you look at the economic expansion, our incredibly long economic expansion that we're in right now, what is the biggest risk factor to that? Is it the Fed?
Yeah, they've always been the one kind of who pushed us over the edge, right? And if they're insistent on hiking rates to the 2.5% or 3% level, which we think is the tipping point, they would probably put us into recession. But I have some confidence that they won't do that, right? And remember, they have this big balance sheet that they're going to be reducing at an increasingly aggressive rate. By this time next year, they'll be rolling off their balance sheet at $600 billion annual run rate. And they keep saying, oh, there's nothing to see here, that's not really tightening. But it is, right? And that can have an impact. The good news is the economy on its own looks really sound, right? The consumer's in great shape. As I said, the banks are in the best financial condition they've been in most of our lives, and certainly my career. Businesses are generally in good shape. Corporate earnings are in good shape. It'll probably be an asset price correction would be my guess to what causes the next downturn.
And when you talk about the balance sheet unwind, it's something we've never seen before. Where can we look to see the impact of that in the markets?
Yeah, that's a great question, right? This is an experiment. I mean, even the ECB, the European Central Bank, is watching from afar saying, well, let's see what the Fed does first, and if they screw this thing up before we start with our own, aggressive tapering and reducing the balance sheet. So it's an experiment. It's the first time in our lives that the Fed has two policy tools that they're using simultaneously, right? So the chance of a policy mistake, just by nature, seems bigger than usual.
And the one thing that everybody's watching from a markets and economic standpoint is tax reform.
Yeah.
So how do you think that's all going to pan out, and what are the critical factors in the tax reform?
Yeah, I mean, it is really in flux right now, right? I mean, just in the last 24 hours, the Senate has come out and thrown in the individual mandate from Obamacare that requires everybody to have insurance, or you have to pay a penalty. They're thinking of removing that. So now you're throwing the health care.
As part of tax reform.
As part of tax reform, because if you don't have all these people in the pool, there's less subsidies that the government has to pay, so it frees up like $300 billion in revenues for the government, right? But that opens up a can of worms, and we already saw what happened with the health care reform debate, and there were a lot of Republicans who kind of pulled back, and some of those same Republicans are on the fence today. Some of the big things we're looking at are the deductibility of interest expense as a big investor in corporate bonds. That's a big deal, right? And some of these policies are going to incentivize companies to reduce debt. So over the long term, some of these can actually be favorable for credit investors.
Great. Michael, thank you so much.
My pleasure, Sarah. Thank you.
Last week, I spoke to Matt Goulet, Fidelity's Vice President of ETF Investment Strategy. Here's what he had to say about people that think ETFs are the new bond king. Can you explain to me why so much financial advisory money is going into fixed income ETFs?
Sure. So you mentioned financial advisors. They're really the ones that are driving this. And the way we look at the ETF user base can split into two broad buckets. There's financial advisors, and then there's retail direct customers on our platform. And if you look at the financial advisor base, a lot of this is really driven from individual bonds and from mutual funds. That's what's fueling the growth of ETFs. And if you step back and look at the individual bond scenario, what we saw is coming out of Dodd-Frank, a lot of the banks reduced their inventory in individual bonds. So we're really seeing financial advisors replace their individual bond positions with fixed income ETFs for the first time. And that's not a trend we've really seen in the retail direct space yet. I think it's coming. I think retail adoption is slowly picking up. But really, most of the fixed income ETF growth is driven by financial advisors.
So if our financial advisors are putting all of their fixed income portfolios into ETFs, should retail investors be doing the same thing?
Yeah, I think there's an education curve, and typically retail follows the financial advisor or the more institutional space by anywhere from 5 to 10 years. So I think you're going to see that pick up over time. Another thing that's driving it, I think, is active management. In the ETF space, active ETFs are still a really small sliver of the overall pie, but financial advisors have really embraced active management in an ETF wrapper, and that's the majority of active ETF assets today is active fixed income assets.
Great. And where are individual retail investors? Where are they putting money in ETFs?
On a relative scale, we always look at the financial advisors versus the retail direct customers, and retail really have embraced sector ETFs. Sector and industry, I should say. So the broad sectors like energy, financial services, and then the more granular industries like cybersecurity for technology exposure. And I think this is really coming, again, from both mutual funds and individual stocks. This isn't strictly an active to passive story where people are fleeing active management. We think it's more of a diversification story and an asset location story. So when I talk about diversification, think about individual stocks, people who may historically have bought industrial individual stocks or consumer staple stocks for dividend income. They're buying the entire sector because they can get it cheaply and efficiently. From an asset location perspective, what I mean there is just simply it's a tax efficiency play. For people in their taxable accounts who want to decrease their tax liability, they're really using ETFs because they're more tax efficient typically than an active mutual fund.
And can you explain that? Why are they more tax efficient?
Sure. ETFs are generally more tax efficient for two reasons. One is the in-kind creation redemption mechanism, and that's a lot of industry jargon, a lot of fun, but really that means is on a daily basis when money is coming into the fund and going out of the fund, it's done on a share-for-share basis. That's a non-taxable event, whereas if you do it for cash, if a portfolio manager sells stocks to raise cash to give you the money back, that's a taxable event. That's what leads to capital gains, both long-term and short-term. So that's reason number one. The second reason is they're index-based for the most part. They have low turnover. You don't have a lot of trading activity within the portfolio on a regular basis. So those are the two reasons that ETFs are generally more tax efficient than mutual funds.